call that key community. And it's a zero down loan with no PMI, conventionally underwritten. So kind of unheard of. I know it blows a lot of realtors' minds. We're like, what do you mean conventional, zero down, no PMI?
Welcome to another Total Talk podcast where we talk about real life experiences. Sit back, relax, and enjoy the show.
What's up, guys? Welcome to another Total Talk podcast. Today we have a special guest. We're going to be talking about loans and about the real estate industry and how it can help you and buy your first home or sell your first home. So let's dive into it. So we have Cody Zuniga. We just want to talk about like the loan industry world, man. Like, how did you get into the loan business?
Yeah, I've always had a passion for real estate, starting back in 2015. Of course, like a lot of people, started reading books on real estate, watching podcasts, and kind of got that bug, right? That real estate bug, as people refer it to. So in 2018, I decided, I'd like to get into the industry, found a bank to work for and started out as a banker. Kind of got a little bit of experience in the financial industry a bit until I was able to move up into the mortgage loan officer role, which was kind of painstaking. It took a long time to convince the bank that, I've got what it takes, because they don't generally hire non-producers. But it happened finally and hit the ground running, started producing, crazy numbers, showed them that we can do it. Just having that passion to drive you, that's really what took me here and got me as far as I've come. But I love it. I do real estate in Oregon mostly. That's where I live. I'm 30 miles out of Salem, the capital here. And being that I work for a bank, I am licensed in 42 states. So I do lend all over, especially over COVID. I had a lot of people who owned homes here in Oregon, but they were looking to get away. So they're buying homes in Florida, Hawaii, made some connections down in Southern California, do a lot of deals in Washington, Idaho, just people relocating. But yeah, we serve a very broad area and, touched a lot of families here in the past few years.
Yeah. What kind of type of loans are you seeing mostly right now in Oregon?
Right now, I would say we're still predominantly conventional, at least in my area. There's a lot more. I think FHA this year or was it 23 over 22 was like 6% uptick. So there's a lot more FHA and govies going right now. And a lot of it has to do with the interest rates, right? FHA is going to be very forgiving. If you have a credit score under 700, it doesn't matter. It's not going to affect the borrower negatively like it will on a conventional loan. So FHA is getting a little bit more popular. There is a stigma, of course. A lot of people don't like FHA because they think they take longer. They're harder to be approved. The appraisal is going to be too stringent. And most everything is unwarranted. The FHA is a great loan. There's really not much negative around FHA. But if you've been burnt before, of course, you're going to share that experience, and then that stigma is going to carry on. So the other loan that we do, it's a specific portfolio loan. So portfolio just means an in-house loan. It can't be sold to the secondary market, right? And we call that key community, and it's a zero down loan with no PMI, conventionally underwritten. So kind of unheard of. I know it blows a lot of realtors' minds. We're like, what do you mean conventional, zero down, no PMI?
Exactly. Yeah.
It's just what it is. But it is going to be a little bit more restricted to where you can buy or what your income caps are. So there are some caveats there. But I was working with a client this morning, and we got to a point to where, hey, I can get you this amount with the zero down loan today. Or if you wait for your tax return to come, which is, right around the corner, then we can move into an FHA loan and get you it was a $50,000 bump because FHA removed their debt to income caps, versus our zero down loan has a little bit more of a strict debt to income cap of 45%. But FHA will let you go, most cases over 50% if there's a good borrowing history. So we try to go conventional more often than not, just because we want our buyers to have a competitive offer And from the listing agent standpoint, they like to see, cash and conventional are king, right?
Yeah.
Then if we can tell them, hey, this is a 100% conventional, a lot of times they'll have questions. So I follow up immediately when that offer is sent in. They see that pre-approval letter. I call and explain, hey, here's what's going on, because it does say conventional on the pre-approval letter. And it truly is underwritten conventionally. So it takes a little bit of explaining.
Yeah. So what's the requirement though for a zero down? Because you'll never hear that. Every time people hear about conventional loans, they think it's 20% down, right? They don't,
Yeah.
that's not the case most of the time,
Mhm.
So what's the requirements for a zero down conventional loan?
So that zero down convention, like I said, there are lots of caveats. One is if the buyer makes less than 80% of the county median that they're purchasing in, then they qualify anywhere in that county with no restrictions to where the home is. If they make over that amount, which most people do, then we will be restricted to where you can buy, and we're looking for a low to moderate income tracks. So we're following the federal government's census from the prior year, and we're looking at what the households made within that census. So if predominantly the people that live there are making 80% or less of the county's median, then that neighborhood will qualify. So we call those LMI areas, and those are the areas they can purchase in. So that's probably the biggest restriction. And then the next is that 45% debt to income requirement, where it's usually not an issue, but in a year like this, where interest rates are up as high as they have been, people have their student loans. The CARES Act is coming to an end. Student loans are coming back live. Depending on what their other debts look like, that 45% could be a big limiting factor, and you might only qualify for 300,000 in a market where that's not going to get you into an entry level home.
Yeah, correct. What's the interest rates on those on the zero down right now?
I
Like
quoted
if they were
7% today,
seven
7%
percent
par. So not
Okay.
bad. They're a little bit
No.
higher than conventional,
Yeah.
but when we compare credit score, so it's a 660 minimum credit score right now,
Okay.
and when you can compare that with a conventional, they're very close. It's a little bit more forgiving than conventional. If conventional was over 700 as far as the credit score goes, then their rate would be considerably better.
Okay.
But like FHA, it's more forgiving. Once we get under that 700, it doesn't really make as much of an impact as a conventional loan does in terms of the rate. But
Yeah.
7% par, it's not too bad, really. I mean, they're
For
with
zero down, definitely not.
and no PMI. I mean,
No
shoot.
PMI. Yeah. So the viewers that are watching, they're asking like, what's a PMI? It's a private
Yeah.
mortgage insurance. So how does that work? For those that don't understand that quite.
Yeah. So PMI stands for private mortgage insurance. It is a third party insurance policy against the loan. It protects the lender. It doesn't protect you as the buyer, the borrower. It's protecting the bank. So it's that if you are making payments on your house and then you default on that loan, you can't make the payments, a certain percentage of that loan is covered by that insurance company. It's required for FHA loans, any FHA loan, and it's required for any conventional loan that you're putting less than 20% down. So that misconception where people think they have to put 20%, you have to put 20% to get out of that PMI, but you can still put up or as little as 3% down as a first time buyer. It used to be conventional loans were 5%, but that changed a couple of years ago, and it's 3% now. So you can get into a house for as little as 3% down. And I don't know what you're seeing in your market, but out of the 60, I think that's about right, 60 purchases this year that I did, or last year that I did, I think we're looking at 2 or 3 people that actually paid closing costs. It's not
Oh,
it's not as often over here that buyers are paying the closing costs. Now there's some strategy to that, right? I mean, you can offer higher to offset and wrap your closing costs in, but for the most part, you can get in for just your 3% down. And I've seen a lot of people go in that 100% down loan, and they're literally walking into that house with no more than a $500 inspection cost or whatever their inspection was,
yeah.
and that's it. You got your earnest money, your EMD, But with that zero down loan, you're eligible to have that refunded to you on the day of closing. The title company can cut you a check and say, here's your earnest money deposit back. And this way, that earnest money that would have went towards the loan just gets rested back on the loan. And in most cases, cash is king. It's important to have a little bit of cash in a market like this, right?
Yeah, definitely. Yeah. I had another question. So let's go back a little bit for the FHA.
Mhm.
What are the requirements for a new home buyer that they don't have a lot of money to put down, right? Um,
Mhm.
so they'll most likely go with an FHA. What's the interest rates? But most of all, what are the requirements? What do they need to do to get pre-approved for an FHA loan?
So FHA doesn't have that debt to income cap. So your debt to income can be over 50%. Generally speaking, 620 is a credit score that we'd like to see. You can get away with a 580, depending on the lender. Some banks won't lend to anyone under a 620, but a lot of cases you can get away with a 580. 3.5% is the minimum down payment. So as long as you can come up with that, there is private mortgage insurance on FHA, regardless of how much you put down. If you put 20% down, there's still going to be some PMI for the life of that FHA loan until you refinance or sell it or get out of it in some way.
Yeah.
But it does decrease, and it did decrease last year. The beginning of last year, if it used to be almost 30% higher than what PMI is now. So all in all, in terms of monthly payment, FHA is going to give you the lowest payment possible. There are caps, though, to that FHA. You can't go over certain amounts, and it's different by county. So, you'd want to check with your local county and see what are those FHA limits, because depending on the size of the loan you're going for, you might not work in the county.
So if someone's trying to buy $1 million house, let's say here in California, it's going to be kind of hard for them for a first time home buyer if they're putting 3% with a low credit.
Yeah. I don't know what counties. I'm curious
Like
to see though.
just the Bay Area, man. Like, in the Bay Area, everything's a little bit up, but I think with interest rates coming down a little bit, from where we're at what 8% last year, a little
Yep.
bit. So now they're almost close to what 6. So I
Yeah.
mean,
Yeah. So they're coming down quite a bit, and I mean that does help. That does help with buying power. I mean, it could easily mean a few hundred, if not more, dollars a month. But in the last 52 weeks, we hit a high. And these are national averages on a 30-year fixed mortgage, a high of 8.03, with a low of 5.99. So just
yeah,
kind of right before those rates really spiked up. So today they're not bad. We're sitting at 6.76% at the time of the recording.
mhm,
Like I said, these are national averages. You can find better. You can surely find worse,
yeah. Just
depending on
depend
the.
where you're at, right? Just
Yep.
just so you know, it's not only that's not the 6.7% that averages. So you can go to another state and you might be able to get it way lower. So these are just
Yep.
averages, you know.
Yep. Yeah. It'll change based on state, change based on lender. Some lenders have um, a thinner margin or profit margin. So they're going to need to actually charge a little bit more. Where I work, and part of the reasons why I've been so comfortable here is we're very competitive on rates. So we try to keep our rates much lower than our competition. And on average, we're 0.25% to 1% lower than anyone else, just because we're trying to make that affordability of homeownership more attainable for the masses. And we're a relationship bank. We're not looking to do the loan and then sell it off and that's it. We hold
Yeah.
and service all of our loans. We're looking for that long-term relationship with the clients. We want that refi next time they're ready to refi. Next time they're going to buy a house, vacation, investments, whatever. We want to be there for them in the long run. So we do try to keep our prices a little bit more appealing. That being said, it's not unheard of to get into the fives today. You could
Yeah.
pay a little bit of mortgage points. So we can talk about points for the viewers that have never heard of buy down.
Yeah. So with points, there different banks offer certain amount of points, right? There's banks that offer 1 point, 2 points. What is your what? How many points do you guys offer?
So I was looking at this is gonna be FHA today. Rate right now, this is 3.5% down with the 660 credit score. Your rate would be 6.25, and that
Okay,
comes with about a half a point. It's
half a point.
0.480.
Okay.
So, not terrible there. For a point and a half, then you can get down to 6%. So it doesn't cost too much, and definitely consult your CPA. Don't take my word for it because I'm not licensed, but points are tax write-off. So if you're buying a property, but like I was saying, with the closing costs being covered or wrapped in via being covered by the seller, a lot of times those points can be paid for by the seller.
Yeah.
Um, keep be cautious because there are caps. An FHA loan, the seller can contribute 6% of the purchase price as a contribution. If you're putting less than 10% down on conventional, it's only 3%. So there are times where someone's like, hey, I'm going to get like a $30,000 credit. It'll cover all the closing costs, buy my rate down to 5 or whatever. But you may not be able to do that depending on the
Yeah.
loan product and the down payment percentage. So, make sure you're checking in on that with your lender. But yeah, I mean, points are going to be there regardless. I look for par to start out. Par just means that it's the rate that has the points that are closest to zero. And today, when I was doing my quote for the zero down loan, it was 7% was the rate, and that was par. So that was the closest zero. That was like 0.2 in points. So
So
fifth of a point.
the people that don't know what are points, can you come and give them a breakdown of what points are and how can it affect your monthly mortgage payments?
Yeah. So points, when we're talking about these, 0.200 or 1 point or 2 points, that's literally a percentage of the loan amount. So if you are paying, say, 0.5%, you find a home, you end up putting a down payment, maybe it's a little bit over 500,000. You end up with the $500,000 loan, but you're paying points of 0.5%. That means you're paying $2,500, and you're probably going to be more familiar with a term called a buy down. So points can also be translated to a rate buy down. So that $2,500 is being used to buy the rate down, so you have a lower monthly payment. The one thing you're going to want to do, and your lender should be bringing this up to you, is, okay, now I'm paying lower on my monthly, but how long does it take me to recoup that cost, right? So if you've got a $500,000 loan, and let's say your loan is at 6.25, right? You're going to have a principal and interest payment of $3,078, so 3080. If you buy down to say 6%, then your payment on that 6% is going to be $29.97, so about $80. But let's say that costs you $2,500. So you take your $2,500 divided by 8, and it tells us that takes you 31 months to break even. Is that good? Is that bad? Like, what you have to do is you have to do some speculation. That's almost 3 years. And what are the rates going to be in 2 years from now? And will you be eligible to refinance your house and get a lower rate? And what I'm saying? Like, we're looking at, what is that break even time? What is your exit strategy? How long are you going to live here? The average mortgage actually only lasts for 3.1 years. Most people refinance or sell before that 3.1 years is up. And in most cases, it's going to be a refi. So right now, I'm not advising most of my clients to pay a lot in mortgage points, because there is an expectation that the rates are going to start coming down over the next 3 years, and you're going to get a lower rate when you refi anyways, and you may end up not gaining any money in the process.
So, for instance, let's say people get let's say they get 6% interest rates on their home, right?
Mm-hmm.
Sometimes, so you're basically telling them, well, if you're gonna buy down to a 5.8, let's just say if it's 5.8 interest, it might not be worth it because then, let's say in 6 months or in a year, they might still be down at 5.8 or
It might be.
5.5. Yeah, so it's sometimes it's worth just uh, going with the current interest.
Yeah, yeah. Do the current interest rate for a while. It's a roll of dice one way or
Yeah,
the other. None of us know what the rates are going to be. We have indicators. We have historics to look at, but as we saw in 2020, your guess is as good as mine on what could happen. But yeah, you want to do what I call it, and I think probably most people would call it a break-even analysis on that
mhm.
cost. Are those dollars gaining me ground, or are those dollars a potential drawback? Am I leaving money on the table? For me, like less than 3 years is a good break-even rule of thumb. If you're taking more than 5 years to break even on your buy down, I wouldn't touch it
Yeah, it's not worth
personally.
it. Definitely not
No,
worth it because then you can invest it somewhere else. You can
yeah,
invest that money somewhere else where you are making some money back, right?
yeah. Put it where it's where it means something. And the same with down payments. A lot of people don't realize how much your your payment is impacted by your down payment. Let's say you put $10,000 against your principal when you purchase
Mhm.
the home. That's only $70 a month in payment.
Yeah,
So, like how long would it take you? You take $10,000, divide it by 70, that takes you 143 months almost. So we're
yeah.
talking almost 12 years to get your 10K back because of a $70 a month payment. Most people think, oh, I'm gonna put 10K, it's gonna drop like $200 a month. Well, it doesn't
And,
work
and
like that.
and most of the time, loan officers don't explain this to the buyers, though, right?
Yeah.
They don't break
My
it down like this.
Oh man, yeah. My call this morning, the guy I was talking to earlier, they were pre-approved last year. They were declined on their loan the day before closing, um, and it was like she said it was a PMI quote. I think that he left off the lender like left off the PMI, didn't explain it. I'm educating her on points this morning. I mean, in a 15-minute phone call, she left thinking, "Oh my God, like I feel like I just had a crash course in education, and I feel so much more confident and comfortable." Even though I was working with this person for 3 months, then we found a place, we went under contract, and I was declined the day before because there's not a lot of information shared. They do train us. It is a sales tactic to not talk rates until we're ready to go. Right? We
Yeah.
we, we do the pre-approval. Let's not talk rates now. I don't play those games. I want to be full and transparent with my clients. I don't want to set anyone up for failure. We're going to look at these. We're going to look at everything, and within a 15-minute conversation, just because we know which questions to ask. I'm going to find those red flags. I'm going to find those road bumps, and we're going to iron those things out before they even have a pre-approval in their hand. Like
Yeah.
we're not going to set the client up for failure. The agents on both sides, the sellers, there's a lot of people's lives being impacted. Not to mention my reputation. A failed sale is completely damaging. So yeah, it's a game that we don't play. It's a slippery slope.
Yeah. So right now in California,
Mhm.
let's say renters are paying as much as people who own a home, right?
Yeah.
The only thing, the difference is these people who are renting a home, they're too busy working or to be respectful. They're not educated, right? So the best thing for these guys who are renting, if you're renting like 35 to 4,000, 4,500 a month or more, you
Mhm.
should consider maybe talking to a realtor and they can connect you to a loan officer and kind of give you a breakdown because if you're renting for $4,000 you can go buy a house that can give you the same mortgage, close to the same mortgage. Now not only that, but you own the land versus you're renting, right? You don't own anything when you're renting. When you buy the home, it's you can do whatever you want. You own it and then it grows appreciation. You can refinance. You can do whatever you want, you know?
It's control. That's how I've always thought about it. It's not even just owning the home, it's controlling that property and controlling what happens with it. A good example right now in current market, I think this probably goes for pretty much all states, is the rates are high. It's winter, right? People are going to be buying houses. If someone's selling a house in winter, do you think they're selling it because they want to move in winter? Like, they're probably selling homes over Christmas and whatnot because they need to. There's some reason that they're motivated to sell. So you can get a good deal right now if you act immediately, right? Depending on your market, right? It's going to be a little different. But in Oregon, it is a buyer's market right now. You can get into a place, get a good deal, and now you control that property. You have a piece of paper that says, I get the final say in what happens with the loan. If it sells, if I'm going to put some work into it and increase my value, whatever. So you buy it low. What do you think is going to happen in the summer when the rates go down? Let's say rates come down 1% over this year, and
the
everyone's
houses are going to go up. Yeah.
gone. Inventory is going to be swallowed up in 90 days. Everyone that I talked to 10 people, 2 people out of those 10 make enough money to qualify to buy a house in this market. So that means that there's so many people that are on the bench waiting, just waiting. And that's your competition now. When everyone's going back at it because rates are down, there you are in the middle of it. Those bidding wars we had in 2020, they're going to be right back at it. So getting the house, controlling the real estate, obviously we're not going to get way into, 1031 strategies and all kinds of other confusing things at the moment. But, outside the scope of what we're talking about, there are so many things you can do by controlling that property that you won't be able to do as a renter. So
and it's like people are trying to time the market, right? You know what I mean? Like, you can't time the market. I mean, you can get lucky in the market,
right.
For instance, like imagine all these homeowners who owned before 2020, right? They had interest of like what, 6%, 7%. And when pandemic hit, boom, they got a 3% of all their properties. If they're investors, they hit jackpot.
Oh my
Right?
God.
They not only that, but they refinanced, they took money out, and they started buying more properties. And I'm telling you right now, if you're waiting for the interest rate to keep dropping, expect homes to keep rising.
Yeah.
It just, you can't time the market. It's better to have time in the market than timing the market, right? Like Warren Buffett says, man. The other thing that I want to talk to you about is the homeowners, right? There's a lot of homeowners, they don't want to sell. Their interest rates are at 3%, 2.8%. They're low, right?
Lucky.
And they feel, lucky, but most of them, they don't want to live in California. They don't want to live in their current space. They feel like they're stuck in their home. What advice could you give them to pull money out or to move somewhere else? They want to move, but they're like, why am I going to move if my interest rate is at 3% or 2% or 2.8%? I mean, why am I going to move? Or I want to move, but what should I do? How can I get some of my money back?
That's a tough one. I'm one of those people right now.
I think everybody.
Was like, why would I move? My payment's so small. This morning, actually looking at a deal it's a screaming deal. It's $300,000 house, 4-bedroom, 2-bath with a giant shop. And I'm thinking, oh, should I move there? I'm absent of a garage and shop right now. So I'm thinking, that could be kind of cool. So my first question was, is your loan assumable? Being that we're in the industry, right? We have ways to see things. So I saw what their rate was. I saw what their original note was when they bought the house, all that. So that was my first question is, can I assume the loan? And for those that aren't sure what an assumable loan is, that just means that you can take it over at the current rate and you get the same terms. Very far and few between. Mostly these are going to be government loans, VA, FHA. Not many lenders allow assumable loans. In this case, they didn't. So what I did with my first house was we lived in it for a while, built a good amount of equity in it. And then we pulled out a home equity line of credit. And I just recommend, if you have a house that has equity, at least grab a home equity line of credit on it, if nothing else, just so that you have the funds there. It's immediate access whenever you need it. It's on demand, so that you have that flexibility and option. But, like you said about taking cash out, and we did this with some of our investment properties during the pandemic. You take cash out of a property, you don't pay taxes on that money. You pay interest, but you don't pay taxes on it. You make $100,000 in your W-2 job, you pay Uncle Sam a big chunk of that. But if you take money out of your property, it's not a taxable event. So you can take that money out, move it into something else. So, let's say you do have something at 3%. You have a really low payment. You're paying a couple grand a month, but you can rent it for 3 or 4 grand. Well, you take your home equity loan out, you use that as your down payment, because there are certain things that don't qualify for down payments. Those do if it's secured to property. You buy that other house, you move into it, you turn your other one into a rental, and you're cash flowing, and your tenants could be paying some or all of your mortgage on your new house. I mean, depending on, how much you have to put down and so on and so forth. But this is how most of the millionaires in the financial industry, have built their wealth, right? Real estate is a huge, huge tool for setting yourself up for financial success. If nothing else, it could be a really good retirement plan, something to leave to your kids. But yeah, that's the way that I would be looking at things right now. If I was sitting in the boat where I've got a really low payment and I know I can get a good amount of cash flow and rent, and I can move into something somewhere else. It doesn't matter if you move into another state. There are property managers who can be your boots on ground and take care of that house for you. Getting a good team, having a good property manager, a good realtor, a good loan officer, a good accountant, a good lawyer, knowing these people and having these people on your team so that you know who to call on. You don't have to know everything to do these things. I know it can be intimidating at first, but jump online, watch some podcasts, read some books, talk to some professionals. And it's right on the other side of that fear is unlimited bliss, right? We know that the greatest things in life are hiding behind our greatest fears. So I just encourage people to dive in and give it a shot, take some risks.
So again, when you're talking about HELOC, when you're talking about home equity loans, people need to understand that you're not refinancing anything, right? So can you break that down for them? Because when they're thinking to themselves, what the heck is a HELOC? What's you know what I mean? Like, what is that?
Yeah.
So they think they are refinancing and their interest rates are going to move, but that's not the case.
No, yeah, with the HELOC, so it stands for home equity line of credit, and it's a line of credit just like a credit card. You think of it like a giant credit card. So on your home, you can have multiple liens against your house, so multiple like loans, mortgages, securities against your home. So you have your mortgage that could be left alone, untouched. And then in a second lien position, you can put a home equity line of credit on the house. So same process as a refi. I mean, you still have to qualify. There's still debt to income caps. There are still credit score caps and whatnot. It takes anywhere between 2 to 6 weeks, depending on the institution. Typically, it's not a full appraisal. It's a desktop or a remote appraisal where they're just looking at online evaluations of your home. But that line of credit. So let's say, you've got $100,000 worth of equity. There are caps. Some places will allow a 70% loan to value. So that means total loans can only equal 70% of your home's total value. So most places are going to be 80%. Sometimes you'll find 90, not so much in this market, but let's say 80%. So let's say you've got a bunch of equity, you've got enough that you can get a line of credit of 100,000. So those funds are just sitting there. It's like another account. Like when you log into your online banking for wherever you've got this line, it just shows up like an account. It says available balance, and you can transfer those funds instantly, nights, weekends, 24/7 to a checking or savings account, and then use them for whatever you want. I do recommend, if you're going to get a line of credit, get it as large as you possibly can. So if you've got room to have a line of credit for 100 grand, take it. If you don't need it, it doesn't matter. Get it while you qualify for it, because a lot of times people will come to me when they need a line of credit and they don't qualify because they've lost a job. They've had some extreme medical expenses, something unforeseen happened, and now they don't qualify. So get it when you don't need it, because typically there's what they call a draw period, and that's the length of time you're allowed to pull funds from that. It's pretty long. So like the ones I have they're 15-year draw periods from the start. So you have 15 years to use those funds. At the end of that draw period, you can't take any more, but you have another 15 years to pay it back. Your repayment period typically equals your draw period. And then the other reason why you want to have a really large line of credit is it looks good on your credit score. If you got a $100,000 line of credit and it's maxed out, your utilization doesn't look great to the credit bureau. So your score is going to drop down. Same way as if you have a credit card with a $5,000 or $10,000 limit and you got it maxed out, it's not going to be good for your credit score. So the recommendation is to keep 30% or less and never go over that 30% utilization to keep your credit score sharp. But yeah, I mean, these lines of credits, mine is on interest only, or mine are on interest only. Because
So can I get you off real quick?
Yeah.
Because let's say now when you pull out this line of credit of 100,000
Mhm.
and you don't use those 100,000, that means that you don't have to pay for those 100,000. You have those on the bench, most
It's
likely,
there.
right?
It's just there
Yeah,
waiting for it. No
yeah.
payment, no interest.
So the ones that pull out 100,000, if you think I have to pay these 100,000 back, you're only gonna pay it if you use it, right?
Right. Right. Exactly. Just like a
So
credit card.
just like a credit card. So if you don't use it, you don't pay it. Also, sorry, I just needed to cut you off to kind of put that in there. But
Yeah.
also,
Yeah.
you're talking about now principals and interest. Now, you're saying that you only pay interest on that HELOC for a certain amount of
Mhm.
time. Is that correct?
Yeah, you have the option. Most places will allow you to at least the first year, sometimes the full draw period. Mine are the full draw period for 15 years. You can have just the interest be charged monthly. So that's your minimum payment. Of course, if you do that for 15 years, then you're not going to pay it down and then you're going to be stuck with principal and interest after that. But it gives you the option, the flexibility. So I like that. I have it auto pay just to set up just to pay the interest portion, and then I pay extra towards principal every month. But what that does for people that are looking at investing is, like, let's say you find a fix and flip. There's a place
Mhm.
that's a really good deal. You could put a little bit into it and then turn around and sell it. Well, for those months, 2, 3, 6 months, whatever it is that you're holding that property, your holding costs are extremely low because you're only required to make the interest portion. So it just gives you that peace of mind too, where you don't necessarily have to feel like you have to pay it all back right away because you've got some time. Of course, assess your plan, make sure you've got a plan to repay it, so that you're not stuck with it. But yeah, I mean, the HELOC is a powerful tool for investors and homeowners alike. Just people that are looking to increase the equity of their home, put some extra upgrades. Maybe that's a good way to do it. Check your IRS code. You might be able to write off your interest on that HELOC if you're putting it back into the house or buying property. But yeah, just powerful.
So with the HELOC, so people don't get it confused. A HELOC doesn't have the same interest as a FHA conventional loan, right?
Nope, nope, completely different. It follows prime. If you ever heard the term prime, right? Prime is what the Fed sets their consumer lending index. So currently it's what, 8.25 today, 8.5, somewhere
Yeah.
around there. And the Fed will meet and adjust up or down. So typically speaking, your HELOC will be tied to prime in some way. There might be some margin above or below, most likely above in this market, to where it's prime plus 1% or prime plus 2%. So wherever it goes, it'll follow, but always be that 1 or 2% higher.
So your interest rates is being adjusted all the time, right?
Yep,
It's
it's
never
variable.
it's never it's not a straight interest, right?
Right. Yep. It's a variable rate. It's a revolving account. So the difference between a mortgage and a HELOC, or the mortgage is an installment loan,
Mhm.
and the HELOC is a revolving account. A credit card is a revolving account. A line of credit is a revolving account. An auto loan is an installment loan. If it has a fixed rate and a fixed payment with a fixed term, doesn't change, right? 20 years, 30 years, whatever, that's an installment loan. But revolving means that it can go up and down. You can increase or decrease your balance by paying towards it or pulling more funds, and then not month to month, whenever the Fed meets, to change rates, that's when your variable rate can change.
So for
For better.
instance, if you guys have been owning for a long time and you have a lot of equity in your home and you have a
Mhm.
low interest rates, the best thing to do is pull out a HELOC, pull it out
I
right
think
now, because if interest rates are keep dropping, then most likely you pay interest only if you want to pay interest only on your HELOC, then your HELOC payments will go down with the interest, right?
Yep. Yep. Your payments do decrease too, right, with the revolving account because it's looking at your
Yeah.
balance. So every month you make a payment, if you put some towards principal, then your payment's going to drop. If you're only making the interest, then it's not going to change. But if you start putting some towards the principal, you're being charged on that new lower outstanding balance. So yeah, every month your payment will go down. It'll look to the calculations of the payments are going to look to pay it off within that draw period. So you're not stuck with a repayment after that draw period ends. So if you have it on principal and interest and you're making the minimum payments, you'll pay it off within that draw period. So for my case, it'd be 15 years. If your draw period's 7, it'd be 7 years. But if you're making the interest only, like I said, just make sure you're being strategic about it. You don't want to sit on something and pay interest for 15 years just to go then and start paying it off, for another
Yeah.
15.
Got to be smart, man.
Wouldn't be a good plan.
Yeah. Also, with the HELOC, it's not like a mortgage either. You don't have a 30-year, right? A 30-year fix.
Right.
So it varies, right? What's the variables on the like 5 years, 10 years, 15 years?
Yeah, I think HELOCs, the shortest I've seen is 5. There might be someone out there doing shorter ones. Why
Yeah.
would you? That wouldn't make
Yeah,
sense.
exactly.
But 5, 7, 10, 15. Those are the ones I've seen. We offer 15. It just makes sense. I just set it and forget it. I wish they were lifetime. Not
Yeah.
lifetime HELOCs. I don't have to ever worry about it again. That'd be great. But 15 is the longest I've found so far, and I'm happy with it now. But in a decade, I might not be excited about it. You just get a new one when the time comes. As long as you qualify for it, as long as you're still working or you haven't recently moved into a commission-only field where you weren't before or self-employed, then you got to show some track record of that income. But yeah, a 15-year draw period is plenty to
But
make some
HELOC is
waves.
a very powerful tool, man. Like,
Mm-hmm.
like I said, if you have like emergency expenses, if you get, laid off, if you want to be an investor, whatever it is, man, like you have that money in your disposal when you need it.
Well, and get it like we talked about, get it when you need it, because when you live in the house, then you're eligible for a HELOC.
Hmm.
There are very few places. There are some credit unions out there, but there are very few places that allow you to get a HELOC on a rental property. If it's not owner occupied, typically you're not eligible to get a HELOC. Like I said, there are some places that will, but once you have the HELOC, like let's say you get it, and then you use that, make a down payment, something else, and you move out, you still have that HELOC. They don't close your HELOC out because you're no longer occupying that home. You still get it for the grandfathered term that was agreed upon. So that's one thing that I've done is I've got my HELOC on the first place we lived in, and then moved to the second and the third. And so I currently have 4 HELOCs actually. So, that just gives you access to more capital. If something comes up, a good opportunity for investments, you just got it. It's just there. You don't have to rush and go grab funds. If you have a unique property, place I'm living in right now, it's a tiny little single wide home. But it's on 30 acres next to a golf course. It was going to be a cash only deal. No one was going to lend on it because it's a 1984 single wide home. We have plans for this property, but I had to go get hard money, and hard money is much more expensive. And you may not have heard that term. So for those who haven't, hard money means that you're getting money from a lender that is not a bank. Usually they're private lenders or mutual funds, and they're going to charge you big origination fees, 3% or more of the loan amount as a cost. And then in 2020, when the rates were super low, I paid like 12.5% interest. It's interest only. You have to have an exit strategy. So, within 2.5 months, I'm refied, right? Like I'm out of it.
Yeah. So real quick, so a hard money loan, the interests are way higher. You're dealing with like a private lender most of the time. So in order to get out of it, like you said, an exit plan would be if you pull out a HELOC on that property. Let's say
Yep.
you can pay that off with the HELOC. Now you got a lower interest rate. So it's how you play your cards, right?
That's exactly what I did. The HELOCs were much lower. Prime was really low, back then, 3.25, 3.5 or something. So my HELOC was really low. So I went from 12.5 to 3.5, right? There are caveats where you can't refinance. Again, no one was going to give me a conventional loan on this place. So I wouldn't be able to refinance into that. But you can find HELOCs out there that they don't really care about the property. This is going to sound really weird, but I did a HELOC for actually, it was called a home equity loan. I'm going to confuse people a little bit more here. A home equity loan is like a mortgage, but it's a simple loan based off the equity. It's still an installment with a fixed rate, fixed term. But it can't change. So if people want some security, they're on a fixed income, they're not looking to invest, they just maybe they need a new roof, they might get a home equity loan on their house. But I did that for a lady. She had a single wide like this. There was a yurt attached on either side of the house. So there's a door busted out on either side of the house that went into a yurt. And she closed in the name of her LLC.
Okay.
So all types of weird things going on there. But just to say that HELOCs you can usually get on properties that you can't get a conventional loan on. And conventional loans, typically, if you have a mortgage on that loan, you have to have it for at least 6 months to refinance it. If you're trying to get cash out, you've got to have it now for 12 months. But with the HELOC, there is no timing period. So all I had to do was get in here, make the house look like it wasn't going to fall down if you blew on it, and then go get my desktop appraisal done, and then boom, within 65 days that 12.5 was paid off, and I'm sitting on a much better interest rate.
I get a lot of questions asking why doesn't my bank or why don't certain banks approve me or pre-approve me for a mobile home, like, or a manufactured home? Like, can you kind of break that down? Why banks don't like doing that?
So one thing to think about is where that manufactured home is. If it's in a park, most banks won't play ball because there's a lot to do, right? We got to have the CCNRs of that park, like what's allowed, what's not allowed. There's a whole nother owner that you're now dealing with. You're not just dealing with the buyer, you're dealing with the owner of that property too. So it's a very specific loan. There's a lot of lenders that do it, but most of them won't.
Yeah.
If it's on your own land, that becomes a lot easier. If you own the land directly, and there's just a manufactured home on it, nothing else, or it could be a garage or whatever, but there's not like other properties. Typically speaking, that's pretty easy. Most of your lenders are gonna be able to do that. We didn't offer them, the company I work for quite a while. Just until September 1st, actually, we turned on manufactured homes. We would do them for home equity loans and for HELOCs, but we wouldn't do the acquisition portion. We didn't have the appetite to hold on to loans for manufactured homes. But we do now. And that's just our effort in trying to make homes more affordable. There are a lot of homes in Oregon that are manufactured, and especially in the southern half of the state, and that are on their own land. It's a very common thing. It's a lot cheaper to put a manufactured home on a property than to build a house, a stick out home from the ground up.
Yeah, and for those watching, when he's saying, if you don't own the land, when your home, like a mobile home, is in a park, you don't own the land that mobile home park is in. So I know a lot of people don't know this, but when you're looking for a mobile home, and let's say you get pre-approved for that mobile home, but you still have to pay rent to have your mobile home in that land. So, for
Yep.
instance, most of the time it's like about $1,200, $1,500, depending where you're at. So if you do get pre-approved, you see a mobile home. Oh, this mobile home is 180,000 or 200,000. Yeah, that mobile home is 200,000, and your mortgage on that mobile home might be about $2,000 or $1,800. But keep in mind that you have to pay the land monthly, so you have to pay for that park, which runs $1,200. So if you're to add $3,000 to your $1,200 monthly, you're actually paying $3,200, right?
Yep, exactly. Yeah, and
So
that adds up. parks didn't used to cost that much, even just a couple years ago, but that spiked just like the rent spiked.
Yep.
You know,
So
landlords are
that's
increasing rents.
that's why a lot of loan officers kind of like but there is some other options, right? There's banks who just focus on mobile homes.
Mhm.
Yeah.
In parks, yeah, yeah.
Yeah, so I mean, if you can find one of those, that
I've
would.
got I got two partners in Salem that I send deals out to if it's a home in a park. You know, you just because you don't do it doesn't mean you shouldn't be able to at least provide that service in some way to your client. I don't do construction loans. I don't do bare land loans, but I know my players in the area that do, and the ones that I know and trust, and I've seen their track records, and I get feedback from clients. I'm not just going to send it to some place off Google because I saw that they do them right. You
Exactly.
have
Yeah.
that personal connection. But yeah, there's a lot of different loan types out there. Rehab loans. I don't do rehab loans. That's where you buy a distressed property and you have enough cash to rehab it during the purchase process. There's a lot of, like, I would say, more nuanced and complicated loans out there that I have, sources I'll refer out for those kinds of things.
Yeah. And where can people find you at? Like, where exactly could they find you at? If they want to, they have any more questions, they want to message you, they're interested in the loans, or they just want to just ask some simple questions. Like, where could they
Yeah.
find you at?
Yeah, I can put a link, put a
I'll,
link to
I'll,
me.
I'll I'll put a link on here on the screen for them.
Cool, perfect. Yeah, and I just email, call. I'm like most loan officers, right? Nights, weekends, we work when our clients are looking to buy. A lot of people work 9 to 5, so just because I work for a bank, it doesn't mean that I work bank hours. I'm not clocking out at 5 o'clock and then
Yeah.
ignoring my phone calls. Like we got to work when our clients need us, when our agent partners need us, and most of the time that's nights and weekends. So cell phone, I'm not shy to give that out. That's it's the easiest way to get a hold of me is just to give me a call, shoot me a text.
And where are you located at exactly?
I am at, you mean in terms of the
Like,
company?
or like your state, and then yeah. So what state, what city or town?
Yeah. So I'm about 30 miles south of Salem.
Okay.
And I'm out of town. I guess one of the biggest hubs is Albany, Oregon.
Okay.
That's right on the I-5. So, if anyone's ever passed through, then they've probably stopped there or at least passed through it. But yeah, I'm just another 45 miles out of the capital, out in the boonies, like my private area out here.
Yeah. So if you guys have any more questions, or you guys want to reach out to Cody, I'll plug all his information down in the link. And then I appreciate you, man. I appreciate you coming on and sharing your knowledge, your education, because the knowledge that you shared with the viewers can help them and kind of give them a little bit of more ease on how to approach a loan officer. Because like I was saying earlier, that a lot of home buyers think that realtors are the ones that approve them. But that's not
Right.
the case. We send them to a loan officers, like people like you, who are genuine, and that can walk them through the whole process of getting pre-approved. So I appreciate you coming on today, and yeah, man, have a good one.
Hey, thanks for having